Have you ever wondered what a stock split is, how it works, why it happens, and most importantly, what impact it has on you and your situation? Well, then you have come to the right place, because today we'll cover all the ins and outs of a stock split. So, what is a stock split? A stock split is like taking a large pizza that is already cut into 8 slices and then cutting it into 16 slices. Cutting the pizza more does not create more pizza, only more slices. A stock split increases the total number of shares each investor owns by a specified multiple, but it does not change each investor's proportional ownership stake in the company. Stock splits typically also reduce the stock's share price by a proportional ratio. For example, a 2-for-1 stock split would double the number of shares each investor owns. However, it would also roughly halve the price per share of the stock in the process. This reduction in share price is typically the primary motivator for a company to issue a stock split. How a stock split works. During a stock split, a company chooses to split its existing shares into smaller units to make individual shares more affordable for investors. Stock splits do not create new shares of stock, they do not increase the market capitalization of the company, and they do not inherently increase the value of each investor's ownership stake in the company. If you hold 5 shares of a stock priced at $200 per share, your stake is worth $1,000. If that stock completes a 2-for-1 stock split, you will then hold 10 shares of a stock priced at $100 per share. The total value of your stake will remain $1,000. Shareholders must vote to approve a stock split proposed by a company's board of directors. Once the split is approved, shareholders do not have to take any further action. Companies will typically announce an upcoming stock split well in advance. The stock split's record date is the date on which existing shareholders must own the stock to be eligible to receive post-split shares. The effective date is the date on which pre-split shares are automatically replaced by post-split shares in investors' brokerage accounts, and the stock begins trading at a proportionally lower split-adjusted price. History of stock splits. The stock with potentially the most impressive history of stock splits is Coca-Cola Co. Coca-Cola shares began trading in 1919, and its first 2-for-1 stock split came just 8 years later, in 1927. In the decades that followed, Coca-Cola split its stock another 10 times, always at a ratio of between 2-for-1 and 4-for-1. In fact, an investor who bought 1 share of Co. stock in 1919 and held on until today would now hold 9,216 shares of stock thanks to all the splits. Apple Inc. is another company that has a long history of stock splits. Apple has split its stock 5 times since it went public in 1980. An investor who bought 1 share of AAPL stock in 1980 would now hold 224 shares. Is a stock split good? Stock splits do not inherently create any value for investors. However, S&P 500 companies that have split their stocks since 1980 have outperformed the overall index by an average of 16% over the 12 months following the split. It's unclear how much of this historical outperformance is correlation and how much is causation. Investors typically see stock splits as positive, which can contribute to subsequent performance. In addition, companies are typically only in a position to split their stock after an extended period of outperformance, during which their share prices can become extremely expensive. These high-quality stocks tend to outperform the market prior to a split, and that outperformance often continues following the split. Reverse stock splits. As the name implies, a reverse stock split is the opposite of a forward stock split. A reverse stock split involves combining multiple shares of stock into a single share, reducing a company's total number of shares and increasing its share price by a specific multiple. While a standard forward stock split is generally considered bullish, a reverse stock split is typically considered bearish. Companies are often forced into a reverse stock split after extended periods of underperformance. The New York Stock Exchange and the Nasdaq both require companies to maintain a share price of at least $1. So companies with stocks that have dropped below $1 often choose to maintain listing compliance by conducting a reverse stock split to boost their share price. Stock splits are typically considered good news for investors. Stocks that have undergone splits have historically outperformed the overall market following the split. Stock splits are intended to make single shares more affordable and appealing to retail investors. There is also a psychological component to a stock split. While the split doesn't change a company's underlying fundamental metrics, a lower share price may make the stock appear on the surface to be cheap to the average investor. Investors also need to be aware of stock splits so they're not confused or shocked when they see one of their holdings trading at a fraction of its previous price after a split has occurred. Affordability. Stock splits can make a stock more appealing to the average retail investor. For example, at a price of more than $2,000 per share, it may be difficult for many small investors to afford even a single share of AutoZone Inc. That kind of stock at the current market price. A lower post-split price also makes the stock appear cheap from a psychological perspective. Value perception. Even though a stock split doesn't inherently create any value, investors tend to perceive a stock with a higher share price as overvalued and a stock with a lower share price as undervalued. Academic studies have found that lower-priced stocks tend to have relatively wider bid-ask spreads, suggesting a stock split could potentially increase the cost to trade a stock. Expense. Companies also require the service of bankers to complete the stock split process. The fees large companies pay bankers to split their stock can approach $1 million, which some investors may see as a waste of money. Short-term outlook. Berkshire Hathaway Inc. CEO and Wall Street legend Warren Buffett has famously chosen not to split Berkshire's Class A stock because he doesn't want to attract potentially lower quality, nearsighted retail traders who may not have the best long-term interest of the company in mind. So, that was it for today, guys. We hope you liked this video. Before going, make sure to like, subscribe, and press that bell icon so that you never miss another video. Till then, goodbye.